All right. A little bit of a confession to make. We're not live.
All right, and we are, I think, officially live. Happy Friday, everybody. We are taking you guys on a new adventure with us. We're going for a walk. And I'll give you a little explanation because Matt has been giving me a bunch of crap for not working out these past couple weeks with him. Normally we wake up in the morning, get workout in his garage. And so to punish us both, not just myself, to punish us both.
Because he's angry about my comments.
Yep. So I'm saying, hey, let's go ahead and get a change of scenery. Let's do this LinkedIn Live outside in the 102-degree heat here in Phoenix. As you know, It was cool last week. We dipped into the 80s, and now the heat's back, and I'm confused. And
should have done this last week.
Yeah, but here we are. If you guys are watching us for the first time, my name's Tim.
I'm Matt.
And we specialize in helping our clients get tax efficient in their real estate portfolios. That's kind of our niche, is we help them buy personal investment properties, and we just make sure that they're running a tax efficient strategy alongside that as well. So anyway, today we're going to be talking about leaving a legacy, why real estate's so powerful for creating tax-free wealth, and then passing that wealth to your family, to your kids, to whoever you're passing that to in a tax-free manner as well. And so we'll just kind of be talking high level about that in case you are curious and you own some rental properties already and you're just kind of not sure what that's going to look like. Or in case you're thinking, hey, I'm going to buy some rental properties and I'm interested in that aspect of it and how I can pass wealth to my kids and build generational wealth and make sure that I'm structured the correct way there. So,
yeah. So you guys have heard the old adage before. We've said it before. Two things in life are sure: death and taxes. And we are thinking a lot about death and how we can avoid it, and longevity and exercise is part of that.
I might die out here on the pavement though, on this walking path.
The one thing that I am sure of though is that we can put off taxes for a very long time. Probably until we die. With current tax structure the way that it is, we've said before, Uncle Sam loves to see investors in real estate, investors in business. Those are the two big things. We talk about real tax savings. One of the big ones is in real estate. Love it. Why is it big?
Yeah. So when we pass properties to our kids upon death, when we pass away, and we do this correctly and we have it structured right, they get a step up in basis.
What's that mean?
What that means is it resets the basis of which, let's say I bought a property 10 years ago and I pass away tomorrow. And I bought the property here for $400,000, but right now it's worth $800,000, right? My basis at that point was $400,000. Minus
what you depreciated, right?
Exactly.
Now, that's a rental property for 10 years. I might have taken
100, 150
easily.
Right? So, hey, your basis might be, let's say 250.
Right.
250, and you're about to sell it for 800,000, right? How much of a gain is that?
Well, we got 250 to 8, 550, $550,000.
550
worth of gain, and this is not just all gain. Some of it is the gain of what you bought it for to what it's worth now, and then also the depreciation of what you bought it for, what it was valued at structure-wise, to what you depreciated down to. So you get capital gains on the one end, and you get depreciation recapture on the other end. And
taxed
at the end
at
of the
ordinary
day,
income rates.
Taxed at some higher rates. Yeah, there's some different tax rates for both of those, but taxed nonetheless.
And this is an investment property. It's not a primary, so you're not like, hey, I lived in it for 2 years. This is investment property being passed to your kids. And so you don't get any of the capital gains exclusions up to $500,000 for a married couple, anything like that. You're getting taxed, right?
Yep.
The time has come. But if
all right. A little bit of a confession to make. We're not live. This is a bit of a hang up for us because what you see there on the screen says live, and we're not.
We're a couple hours ahead recording this, but it's a good thing that we did, because if we were live, my phone overheated in the heat, and just like all those jokes we were making prior about it being really hot in the 102-degree heat, my phone lasted about 3 minutes of us recording, and we had to walk back to the studio. So We are back here, so we'll just pick up where we left off.
Yeah, so we talked a little bit about how kind of the depreciation and capital gains and then the step up in basis worked. We're just kind of talking about that. So again, we have a house that purchased at 400,000 maybe and depreciate over time, brings its basis down to about 250, and then it's worth double what we bought it for. It's worth 800,000 now. At some point, if you sell, that tax becomes due. So you end up with some capital gains tax on the top end, and you end up with some depreciation recapture on the bottom end. Those are taxed at one's taxed at capital gains rate, one's taxed at ordinary income rate.
Yep.
And with that, we'll have kind of a mixed tax category where we have to pay taxes on that situation. Here's the thing, though.
Yeah.
We don't sell, keep that property, and we pass that property to our kids when we die. The IRS says you now have a step up in basis. The value that you had, the tax basis that you had of 250,000 is no more. The value is now set at the value of what it is today, the day that you died. So your kids now have an asset that is valued according to the IRS for all purposes at $800,000 at that point.
Exactly, and that's the most powerful part. And I think this is what most people miss is they say, okay, well, what if I don't want to pass these, or what if my kids don't want these properties, right? Because once you acquire 3, 4, 5, 10 properties, like a lot of times we see, okay, well, the kids, they got their own thing going on, right? They have their own businesses going on. They got other endeavors. They don't want to own these properties that you've owned for 30 years that maybe need some maintenance, or they're just older properties that need to be turned over. But what if they don't want to run that? Well, still, that's okay. Like the week after you die, they can put them on the market and sell these
Thanks,
things.
Dad.
And
Thanks, Mom.
You've passed those assets tax-free. You've passed your wealth tax-free to your kids. Now, obviously, there might be some caps there in what you're able to pass fully tax-free. But for most people, like this is not just a strategy of the ultra wealthy with mega portfolios, right? This is for the guy still that has 1, 2, 3, 5 properties, rental properties that they've acquired over the course of their life. They've structured it the correct way. And now they're going to be able to pass these assets to their kids. And look, the third thing we want to touch on specifically about leaving a legacy to your kids is leave them more than just the wealth. We've got to be talking to our kids about the secrets that we know about the IRS code. There we go. We're back. Our screen just shut off, but we're still recording, so that's good. And so, we've got to be teaching them about what we know about the IRS code. We've got to be teaching them how to use the losses of real estate to offset the active income from their businesses. Like, if you can set your kid up with the financial knowledge, don't just give them the fish, give them the fishing rod. Like, teach them how to fish, because they're going to be far more successful than you were because you started at 0, right? And now you get to start them from level 10 when you pass and they can acquire those properties. And hey, maybe they just have a step up in basis and they can go ahead and depreciate those things more over and over and over again, right? And their kids can do the same thing as well.
Yeah, they get one shot at it. They get one depreciation schedule.
Yes.
Maybe multiple split up, depends on how they do it.
Yeah. Well, depreciate multiple properties though.
Correct,
They can offset their taxable income for the year over and over and over again because of the losses that are available to them with 5 properties, 10 properties, right? So they've got this massive bucket of losses now they can utilize. And now you've set them up to be able to say, okay, I'm going to defer my tax bill now for the next 10 years. That's going to supercharge my ability to grow wealth, grow the portfolio more, jump into businesses, take some risks, right? It just accelerates everything. So I think that's, we wanted to touch today on really the importance of leaving a legacy to your kids, specifically through real estate, because in our opinions, it's the most powerful asset class that you can. For one, eliminating your tax burden now, right? In the current year that you have it, building wealth in the long term, and then also passing that wealth tax-free. So it hits kind of all the things that you might be looking for in a long-term investment, but also gives you some really good, immediate benefits to be taking advantage of when you can. Oh, there we go. There's a thumbs up. I think, for anybody watching this video, if you already own rental properties, you own 1 rental property, you own 3 rental properties, you have 5 properties, right, that you have rented out right now, but you're not 100% sure if you're running it tax efficiently. if you're not sure that you're taking advantage of all the of all the advantages that are in front of you, if you've had some conversations with your CPA, and if you're not even sure that your CPA is filing your rental portfolio, you need to make sure that that's on the books for conversation come tax time. Yep. But reach out to us. We're real people. We answer our DMs. And look, I think it's really easy for us to all become complacent. Investors have become lazy. Agents have become lazy. CPAs have become lazy. In the wake of what's happened with real estate in the last decade, and especially in the last 2, 3, 4 years, it's really easy to become complacent and say, hey, I'm just, there's no deals out there anymore. Or maybe you're sitting there and you're like, well, I really only care about cash flow, and that's the only thing I've optimized my properties for at this point. I actually haven't really thought about the tax benefits. I don't even know what's available to me. I'm sure that my CPA is taking care of it, hopefully, right? If that's you, reach out, just ask the questions. If you've got properties, we'd love to just chat through what your current setup is and figure out if there are ways for us to add value to what you currently have going on. We love diving into topics like that, jumping on a Zoom call with you and working through what you have going on and what might be possible. So anyway, with that, everybody have a great Friday. This is Friday. We were just a couple hours ahead of recording the video, and then we're putting it as a live. So don't give us too much flack. But I think in the future, actually, Matt and I were talking, we really like the 3 minutes in the outdoors that was. So once it starts to cool off here in Phoenix, we're going to keep hiking around and maybe do some more live videos walking around.
Share some live videos from there. It'd be fun.
Yeah. We'll make sure that we pre-record them so all the mistakes are taken out. No, you can clearly tell we don't edit these videos.
No chance.
Anyway, have a great weekend, and look forward to hopefully having you guys